Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, October 30th. The US equity bulls were enchanted with better than expected results that Alphabet just released after the market's closing bell yesterday. And the cherry on top of it, the US job openings data came in softer than expected. Now today, all eyes are on the US ADP report, the European inflation updates, and Microsoft and Meta earnings that are also due after the closing bell today. So tune in, we have a lot of information to digest. So mood in major US stock indices was rather bullish at yesterday's trading session ahead of a series of earnings from 5 of the Magnificent 7 companies and other big companies as well. Of course, was on the earnings calendar, and big tech investors weren't disappointed, mind you, as Alphabet announced better than expected results yesterday after the bell. So Google's parent Alphabet saw its revenue rise 15% last quarter from the same time last year. The advertisement revenue grew more than anticipated by analysts, and more importantly, as Google Cloud printed a solid 35% growth compared to the same time last year. So the company earned 11.4 billion US dollars from the cloud division last quarter, and that's comfortably above the 10.5 billion US dollars revenue penciled in by analysts. So Google was up by around 1.66% yesterday before the earnings release and rallied nearly 6% after the bell after the release. And it could have performed better if not for the serious regulatory issues that the company is facing these days, including an antitrust trial questioning its monopolistic position. And this trial could actually require the company to divest major assets like Android, Google Play, or Chrome. So that's quite rough. But anyhow, Alphabet's latest beat actually serves as a fresh rebuttal to those investors who fear a slowdown in AI demand. And well, news at AMD were not enchanting on the other hand, because one of Nvidia's biggest rivals in AI chips also posted its third quarter earnings yesterday, and unfortunately the company gave a lackluster revenue forecast for the current quarter. So that was obviously a message that raised a couple of worries about potentially slowing AI sales in the foreseeable future. So today, it's Microsoft and Meta's turn to reveal how well they did last quarter after the bell, of course. Then the earnings announcements will continue throughout this week, with Apple and Amazon that are due to announce their own quarterly earnings on Thursday, always after the closing bell, and Friday will bring some light on ExxonMobil and Chevron earnings. But the latter may actually be less enthusiastic for their investors because, well, BP, the British BP, announced its quarterly results yesterday and they were quite mixed. The company reported the slowest profit growth in nearly 4 years due to weak oil prices. So that was eventually better than expected by analysts and topped with a 1.75 billion US dollar worth of a buyback program. But alas, the company warned that they could eventually change this strategy to buy back 1.75 billion US dollar worth of shares every 3 months due to weak oil and gas prices. So the BP shares slumped 5% at yesterday's trading session. And speaking of oil prices, the barrel of US crude remained under a decent selling pressure at yesterday's trading session, and a slightly better bit this morning on the back of a small decline that we see in US oil inventories yesterday, according to the API report. But the price is consolidating near the $68 per barrel level. Trend and momentum indicators remain tilted to the downside, and strong resistance is eyed near the $70 per barrel psychological level, which also matches the minor 23.6% Fibonacci retracement on July to September sell-off in US crude. Because we all know that the fading geopolitical tensions in the Middle East that were actually supportive of the oil bulls until this week have this week left their place to Chinese growth worries and also supply-demand discussions, which both are negative for oil prices. Because in fact, World Bank now thinks that global oil supply will exceed demand by 1.2 million barrels per day next year. So that's something that the world doesn't experience quite often, to say the least. We saw that, so supply exceeding demand in the pandemic times and back in 1998 during the oil price crisis. And well, that also makes me think that oil bulls have still one important card that is left in their hand to reverse this bearish situation, and is a potential U-turn from OPEC and OPEC plus countries that could eventually cancel the production restoration plans. But for now, there are no concrete news or no concrete signs of it. So I'm just thinking aloud, and until then, well, the price rallies in oil will likely remain limited. Elsewhere, on the data front, the first glimpse at the US jobs numbers were rather soothing for the Fed those yesterday. So the JOLTS data released yesterday in the US showed that the US job openings fell to the lowest level since 2021, and Atlanta Fed's GDP now forecast dive below the 3% mark, pointing at a slower growth in the third quarter than it previously estimated, and that was based on the bulk of economic data and economic data releases that the forecast takes into account to make this prediction. As such, the US 2-year yield is now testing the 4% mark to the downside, and the US 10-year yield consolidates near the 4.25% level. The US dollar index eased yesterday after hitting a fresh high since last summer, and today all eyes are on the US ADP report. Analysts expect that the US economy may have added around 110,000 new private jobs in October. So a softer than expected data there could further back the Fed dose and weigh on the US dollar, whereas a strong looking data will probably do little to erode the rate cut bets for the Fed until we have more clarity from Thursday's GDP data and core PCE figure and Friday's official jobs report from the US. Phew, that is a lot of data coming up next. And before that, we have also a mountain of figures to digest from elsewhere in the world, because earlier today, Australia revealed higher than expected inflation number in the third quarter. But the September figure happily was lower than penciled in by analysts, and that actually kept the Aussie bears in charge of the market. The Aussie dollar continued to advance toward the 65 cents level, pressured by a broadly stronger US dollar and also softer iron ore prices on the mounting worries that the Chinese stimulus measures will unfortunately not be enough to stimulate the desired growth in China. And here in Europe, the major Eurozone countries like Spain, France, and Germany will be revealing their own October preliminary CPI numbers today, which are expected to show a certain uptick in their headline inflation figures in October. So if that's the case, if we see a higher inflation, we could also see the Euro bears give back some field and let the Euro dollar rebound after a four-figure sell-off since the end of September. Now, first resistance here is eyed at 108.70 level, so near the minor 23.6% Fibonacci retracement on that latest sell-off and the 200-day moving average. And the key resistance to this bearish trend sits at 109.35, which is the major 38.2% Fibonacci retracement. Now, I see that resistance or these resistances pulled out only in case of surprisingly weak jobs data from the US this week. Otherwise, the bears will continue to remain in charge of the market. Elsewhere, cable is testing the 130 psychological level ahead of today's budget announcement. Amid hopes that the Chancellor of Exchequer, Rachel Reeves, will handle the announcement of the largest tax increase since 2010 austerity measures with enough tact, and the dollar-yen consolidates above the 153 level ahead of tomorrow's Bank of Japan policy decision that's expected to bring nothing new on the table, if not a pledge of more monetary support to the Japanese economy amid the rising political uncertainties there. And because we don't want to not comment on that, well, Bitcoin reached the highest level since March this year, and that's basically on the back of rising odds for a Donald Trump win at next week's US election, which is also sending Trump's media and technology groups shares skyrocketing these days since the end of September. Now, the prediction markets actually assess more than 60% chance for a Trump win at next week's presidential election, while on the other hand, the latest CNN poll gives 47% chance of winning to both candidates, both Donald Trump and Kamala Harris, making the Trump-friendly assets gains quite vulnerable. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.